Hello there. Welcome to Market Call. Our guest is Girard, Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. He's going to be taking your questions on global stocks. There is the number to call right now, 1-855-326-6266. We have our ace call taker standing by, or you can email us, marketcall@bnnbloomberg.ca. Brett, thanks for joining us.
Thank you for having me back.
Of course, the markets are driven by fear and greed, and you think, well, fear is top of the agenda right now, and people should be paying a lot of attention to risk management.
There's a lot of emotions right now. We're just a week, not even quite a week after Liberation Day, and you know, it's a big green day today, but the last couple have been quite red. That's emotional reactions. That's knee-jerk. That's people looking and saying, oh no, I need to get in, I need to get out, and primarily, I need to get out. I think what folks need to do, you know, if they're not working with a professional, is just step back and think about risk management. Think about their asset mix, what they're holding, and why they're holding it. If you're more than 5 years from retirement, then you're okay being all into equities.
All equities.
All equities, yeah. If you're more than 5 years away, maybe more than 10 years away, like you can withstand the volatility. And volatility in the equity market is a feature for those who can be rational and who can take advantage of pricing swings like this. If you get emotional and you get out, then that probably means you have too much equity in your portfolio and you have to start to layer in some fixed income. So for the folks that are maybe feeling emotional right now, or the folks that are 5 years or less from retirement, or in retirement, you should have a healthy weighting to fixed income. And if we look over the past week, the fixed income's actually done quite well. Corporate bonds, fairly flat. Government bonds, fairly flat. We're seeing some movement up and down, but not really any price change compared to equities. So this is really when you want to manage the risk. This is when you want to have the balance in the portfolio. The equities are giving you the growth, but if the growth is going to go away for a little bit, you have to have some of that income and some of that safety with the fixed income.
Sometimes I look at my portfolio and it's mixed.
Right.
And I think, gosh, should I just put it all into Canadian dividend-paying stocks?
Right. Yeah. And you know, that's been a strategy that people have been after. There's a strong home bias there because we're very familiar with the telcos, we're familiar with the banks, and familiar with the insurance companies. But Canada as a country right now, we're a little bit on the ropes. And it hasn't been this bad over the last 10 years, but we sort of degraded into this position where we're today. So if you're betting only on Canada, you're employed in Canada, you have a house that's likely in Canada, you're very, very concentrated into a nation right now that's not in the best shape. That might turn, and hopefully it does over the next little bit, and we can see brighter future for us. But right now, being very concentrated in just one country that's only about 3% of GDP, that doesn't make a lot of sense.
I guess, well, I mean, we could discuss this all day, but one problem is even if you are less than 5 years from retirement, you're likely to be years, maybe decades in retirement.
And that's exactly right. Even if you are panicking now and maybe you feel like too much equity in the portfolio, if you step back and think, in any 1 year of retirement, you might draw 2%, 3%, maybe 4% of your portfolio. But it's likely that the majority of the funds that are in your retirement account are going to be drawn down over decades.
Yeah.
So yes, absolutely, this is causing concern. You know, the market's up and down. It's not nice to see the big red and another big red and then a big green. It's unnerving, but you have to step back and think, what am I doing and what is my horizon that I'm trying to manage for?
And you say, I mean, we've seen 20% drops in 2018, 2020, I guess that was COVID.
Yes.
2022, I guess that was the tech melting down.
That was the tech, and then also just the interest rates going up with inflation.
So we've seen this before.
Yeah, so the average intra-year drawdown over the last 75 years is about 14%. And over the last 5-6 years, we saw 18, we saw 20, we saw 22, and now we're seeing 25. So investors, as much as we don't want to be accustomed to this is fairly normal for the markets. The driver of this is it's very self-inflicted because of the tariff. So that's a little bit different than what's happened in the past. And that's why I think the playbook for this period might be a little bit different. Before we had these buyable dips, so it was very easy to get back in right away. This is much more dependent on an individual and then the interactions of a certain individual with many other leaders of countries. So it's President Trump, and then it's the negotiations with every other country. So we'll see what happens. If this is more of a bargaining chip, then we could have a V shape. But if this is something where tariffs stay in place for longer, it's going to be more prolonged, more protracted, and we will likely see a recession.
Girard is our guest on Market Call today. He's Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. He's taking your questions on global stocks. And there's that toll-free number, 1-855-326-6266. We have an email from Gerald. Would you buy Nestle at this price as a growth stock? I guess a classic global blue chip.
Yeah, I think growth stock might be maybe the wrong terminology to think about it. This would be more of a value play, sort of a steady Eddie, and we can see the chart here. It hasn't really done that much for the last year. We're a little bit down, but when we get into times of flux, there's this concept of moving out of consumer discretionary, so some of those more high-priced discretionary purchases, and moving into consumer staples. You could argue that chocolate is a consumer staple. I know my wife every morning has to have her chocolate. So it's one of these companies where they have lower priced goods. It's not luxury by any means, and they're ubiquitous in the stores. So if you look at like a Nestle or a Unilever or P&G, any of these big consumer packaged goods companies, having something like that in the portfolio is generally helpful. You're getting a higher dividend yield, so you're getting just under 4% on this name, and you'll likely see less volatility than you would the broader market, just because it's more of, when you have a consumer staple, the demand is more consistent and more steady over time.
Right. Yeah, it's not going to be a shoot the lights out one. Right. And of course, the classic alternative there would be a Unilever. So yes. The stock in Swiss francs trading at about 85 Swiss francs. It is down, though, I see, from 2022. It was closer to 130.
Yeah, and all of these CPGs, the Unilevers, the Nestles, right. The Procters & Gambles, they've all kind of been exposed to this this trend of folks becoming healthier. So they're moving away from some of the junkier foods and getting into more of the healthcare or the sort of healthy foods, things where it's better for your body to put in. So we actually own Unilever. That's a name that we have. And if you look just as Unilever as an example, they're planning to spin off the Ben & Jerry's ice cream division.
Oh, no, isn't that?
That's Unilever.
Oh, Unilever.
Unilever,
yeah.
So we own Unilever, which would be a competitor to Nestle.
Yes, sorry.
So Unilever they're looking to spin off the Ben & Jerry's ice cream division, because that's sort of the old way and not quite as healthy. Okay. And they're doubling down on some of the soap and the fragrances and more of the personal care items, which there's more margin on, and they see more of a future in that going forward. Yeah.
I mean, the packaged food companies apparently are scrambling to come up with stuff that'll suit the new diet drug world.
Yes. And I mean, the semaglutide and the Wegovy's and the Novos, they're really fundamentally changing the landscape. Yeah. We used to own a name called JM Smuckers, which makes icy freezies and a whole bunch of really good cookies and things like that, that when I was growing up, we used to eat as snacks. But now kids these days, even their snacks are much healthier. So we sold that name a while ago, and the stock has just precipitously gone down because there is this real ground shift in consumer preference.
And I guess packaged food, unfortunately, it's just not healthy by definition.
The more podcasts you listen to, and the folks who are into health, they keep talking about having single ingredient food, and the less time that it sits on the shelf, it's probably the better for you.
And a bag of spinach doesn't take that long to cook.
Yeah.
Just throw it in with a bit of garlic and oil. I know, but anyway. Yeah. Oh, okay, Mary in Burlington, Ontario, go ahead, please.
Hi, Andy. Hi, Brett. Thanks so much for taking my call. Brett, I'm wondering what you're doing with your Littell fuse. Are you hanging on for dear life, or are you buying more? Thanks so much. I'll hang up and listen.
Littell fuse, little fuse. What do they do?
Yes. So different pronunciations. Even within the company, sometimes they'll call it Littell, sometimes they call it Little. They're a maker of fuses, as the name sounds like. So a lot of electronics manufacturing. If we see the dip in the price over the last little bit, and really the last couple of days, it's been primarily driven by the tariffs on the auto industry, because they supply a number of fuses into electric vehicles. Cars are basically now just computers on wheels. Yeah. That's really what they are. So there's a number of electronic components in vehicles. Littell Fuse sells into that, and that's hurt the stock in the last little bit. We still like the name. We understand when you're buying a small company like this, and this would be considered a small cap, there's going to be volatility in the name. There's going to be prices moving up, prices moving down. The market cap's only $4 billion. So it's quite small compared to the things that we'd normally talk about on TV. But this is an opportunity where volatility in equity prices is a feature. So it's an attractive thing. It's not a bug. And sell-offs like this give you an opportunity to leg into a name, not a big position today, but you can leg into it, and over time you can hold and buy more if you believe that the auto industry will come back. And if you look at the dynamics of the auto industry in particular in North America, there's obviously claims that Canada's dumping auto products and Mexico's dumping auto products into the US, but 75% of the auto workers in North America are employed in the US. So if we think that that industry is going anywhere, it's not. It's just we're in this negotiation. The auto workers are front and center in that. At some point, it's going to get resolved. Prices might be a little bit different once we hit resolution. But a company like Latelfuse that's down the way it is on sale in our minds and something that people could hold for the long term.
Joe is in Montreal. Go ahead, Joe, please.
I want to ask you a guess about Bank of America. It's been down for the last couple of months, especially when we saw that Mr. Berkshire was getting rid of some of his holdings. And I've had this for over 20 years. I did sell a couple hundred shares at the beginning of the year because of the exchange rate. And of course, it's been really down the last few sessions. I want to guess a viewpoint on where he thinks that this stock will go in the interim, whether the tariffs go through or not. Thank you.
Bank of America.
Yeah, so the big risk with the tariffs, if we kind of step back and think about it, is that the prices of goods inside the U.S. are going to be higher. And that's ultimately what it is. It's goods coming into the U.S., we're adding an additional fee on top. The fee goes to the government, but the consumer takes that on the chin. So if we get to a point where the consumer is struggling and the consumer is unable to go out and buy goods, because at the end of the day, if you look at GDP in the U.S., about 60 to 65, 70% of it is consumer spending. So if the individuals in the U.S. start to struggle, if unemployment starts to tick up, if these tariffs have wide-ranging impacts over a long period of time, then there'll be less spending, that will slow down the economy, and that will directly impact a name like Bank of America. So I think today it's hard to know what the impact of these tariffs are going to be because, again, it's this sort of multifactorial negotiation. If you have the name and you've held it for 20 years, you're probably up significantly. I suspect the dividend is quite high, the yield that you're generating over time. So I would be reluctant to sell it based on the last 8 days or 7 days based on these tariffs. I would be more inclined to hold that, avoid paying the tax, continue to collect the dividend, and then maybe sit on the cash from the dividend for now. And there might be other opportunities that you can use to put it to work.
Yeah, I'm showing you a yield of about 2.9%.
And that would be today, but if you bought it 20 years ago, your yield at cost, the dividend's been increasing over the last 20 years, you're probably 10% on cost.
It's interesting, actually. My chart is showing that it's still down from just before the financial crisis, but it certainly was a great buy in 2009. It's been moving up since then.
Yeah, so they, if you look at sort of the big four in the U.S., J.P. Morgan's probably done the best.
Right.
Wells Fargo's had some challenges. Bank of America's had some challenges, but they've largely recovered over the last little bit. But it's the U.S. consumer. So if you believe in the U.S. consumer over the long term, which I think you can get behind that, you're going to have some volatility. But this would be a name to hold and a name to have.
Brett Girard is our guest on Market Call today. He's Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. Global stocks are on the menu. Let's go to Thunder Bay, Ontario. John, fire ahead, please.
Hey, thank you for taking my call.
Pleasure.
It's kind of off topic, but anyways, I invested in gold and silver. I had an Eco, which, as you know, everything was doing really good about a month ago. And before the Liberation Day, I sold half my Eco. I hope that was a good move on my part, but did not sell my silver stocks like Silver, Wheat, and Endeavor. Is this any advice you can give me moving forward on precious metals?
So this is a perfect example of risk management. You're up, you sell a chunk of it, right? And this stock over the last 3 years I have in the chart in front of me, it's up about 100%. So gold has been a strong beneficiary. There's the 1 year 73, and if we look at the longer term chart, up even more. Gold has been a significant beneficiary of the thought of inflation, central banks concerned about the USD. There's just been a lot of demand for gold over the last little bit. Since Liberation Day last week, we've seen a little bit of rockiness in price and a little bit of decline. I don't think that that's necessarily having to do anything with gold. I think it's probably because people are holding gold as a part of their portfolio. And if they're delevering or if they're taking leverage down across the whole portfolio, they would take it down in tech, they would take it down in industrials, and they would take it down in gold. But fundamentally, the thesis is sort of still intact. If we look at these tariffs and we believe that they're going to be in for a longer period of time, that's going to be inflationary, that's going to be positive for gold. In our portfolios, just as an aside, if I could, we don't actually hold any gold because we like to have yield. We like dividends coming in, especially for our folks who are in retirement. So there's a nice analog that we found called the CME, which is the Chicago Mercantile Exchange. And they're kind of like the house where you can trade any commodities. You can trade gold, you can trade silver, you can trade some of the softs like canola, you can trade hog bellies. And what we saw is over the last couple days since the 2nd of April, in those big down days, CME was actually up. So it's a really nice hedge to have into the portfolio. And it's something that, again, because we don't want to have stocks without dividend yields, we're passing on gold, but we're opting into a name like CME.
And the symbol CME.
CME,
and the yield about 2%, right?
Yeah, so the yield is good. They're often declaring special dividends on top of that,
I see.
which is really nice.
Yeah.
But it's a way that you're not susceptible to the supply and demand of the underlying commodity, because commodities are always moving in and out of favor.
Yeah.
These folks, they're just going to take a cut every time there's a trade. So when we have volatility, when we have trading, if next year it's copper, if the year after that it's palladium, CME is going to benefit from that throughout.
Yeah, I'm showing the stock up 11% this year.
Yes,
Wow.
in spite of everything that we've had the last couple of days.
Gregory is in Fort Erie, Ontario. Fire ahead, Gregory, please.
Hi, how are you guys? First-time caller, big
good.
fan of the show.
Thanks very much
I was
for calling.
just wondering if I could get a long-term view of Alibaba.
Alibaba, you got it. Thanks.
So it seems like, and we keep on going back to the tariffs, but the country square in the bullseye of this tariff talk is China. And until we get a resolution between the U.S. and China and a more steady place, because right now there's tariffs and counter tariffs and counter tariffs. Until we get a resolution on that, I wouldn't be investing in any of these names, just because the exposure is unknown. And it could be a fairly negative situation if it ends up that the U.S. tariffs, they were already 34%, they added another 20, so they're up to 54. Talking about another 50% on top of that, we get to 100, and it could keep on going from there, because these two nations seem like they don't want to back down. They're sort of at each other's throats right now. So we had a bit of a recovery because primarily the Chinese market really fell off in 23, 24, driven by real estate.
Right.
Now we've had this recovery into 25, but then with this tariff talk, the name has come off. So there's lots of places to invest right now. I just think this is really high risk, and without having a clue what the tariffs are going to end at, I wouldn't be interested in investing in this name.
Yeah, the shares, I mean, they are up this year, but they went to almost $150 in mid-March, and now they're down to barely more than 100.
More than 100. And you hear folks talking and saying, China's really cheap and this is a good place to invest. It's challenging for us just because there is sort of a different system in place. It's not a democracy there. There's central planning, and if the government wants the stock to do well, then there's going to be stimulus, and it will. But if it ends up falling out of favor with the administration, then you're kind of stuck holding this.
You're right, yeah. If an executive ticks them off or something. Yeah, that's right.
And that's happened before.
Yeah. Paul is in Toronto. Go ahead, Paul, please.
Yeah, hi, good afternoon. I just wanted to know about Tesla. It is my opinion, like this stock, people, trade it with whatever comes out from the White House. It goes up and it goes down. So what are your thoughts? So is it going to touch 200, soon?
Okay, thank you very much.
This is another name. I don't think it's really possible to handicap right now. You have to give Elon credit. He's sort of taken this company and convinced the market that sales will always get better, and there's this next future which is going to be self-driving cars, or it'll be robo-taxis, whatever it is. He's done SpaceX. He owns Twitter now, which is X. Like he is a very remarkable entrepreneur. But there's a lot of promotion in there. And right now, in the U.S. in particular, the base of people that are driving Teslas, and around the world, but the base of people that are driving Teslas, I don't think they're that happy with what's going on from a Doge perspective or a White House perspective. So we're seeing the protests in the street. We're seeing the backlash. If the company can make it 10 years, then there probably is going to be a lot of revenue from self-driving cars, but they have to get from here to there. And currently sales are declining, and the brand, which has been so important to keep the price up, the brand's fallen out of favor. So this wouldn't be something that I would invest in for now. Maybe you can keep an eye on it, and there might be an opportunity in the future. But I just think it's so uncertain, and when you have a leader like that running the company, it becomes synonymous and so tied to the fortunes of the company, that if things don't go well in the White House or if that ends badly, then that could reflect even more negatively than it has on the car company.
And the stock rallying a bit today, but down 40% this year.
It's a big move. Yeah. And again, when you're capital intensive business, you have to continue to go to the market to raise money. And so when stock price is high, it's easy. I go out and I can sell a lot of shares at high prices. When prices are down, it's much harder to do so.
We got to take a break. When we come back, we'll have a look at Brett's past picks. You're watching Market Call. Let's check out Brett's past picks. He was on our show April 22nd of last year. Brookfield, BN was the first idea, and this one up almost 30%.
And it was up even more, if we look sort of a week ago.
Yeah.
Really high quality name, based in Canada, so nice way for Canadians to use Canadian dollars and access global investments. The price has come down over the last probably 2 months, really since Inauguration Day. The challenge that Brookfield's facing right now is they do invest in private businesses. So when they're buying private businesses, the way that they make money is they have to buy them at a price and then hopefully sell them for a higher price in the future. But with all the volatility in the stock market, the idea of selling a private business or taking a private business public has been put on the shelf right now. So IPOs very limited this year. We're not seeing nearly the liquidity that we had before. So it's not the end of the world. It means they'll continue to run the assets. They'll continue to grow the businesses privately. And at some point when the markets get a little bit more conducive to it, they'll be able to bring those public.
Right. Now, the Financial Times a while ago had a piece that the circular nature of some of their real estate transactions is raising eyebrows. A lot of it was based on talking to a Veritas analyst who's been a critic. And I don't think there's anything new there. They're in real estate and they have complex dealings.
That's right. And when you're investing across many different countries, there's going to be corporations here and corporations there. They're trying to minimize tax, which all businesses do. So there's rules that you must follow from a tax minimization perspective, but within the frameworks of minimizing tax, if you follow those rules and you're reducing tax, that's actually what your shareholders are looking for. So there's often accusations. It is a confusing org chart to look at, but I would say the same for a KKR or for an Apollo, any of these private equity companies. They are masters of going around the world, finding undervalued assets, holding them for a period of time, and then selling them for more than they bought them. So sometimes that requires financial engineering, and that's just all part of it, provided they're following the rules.
Yeah, and Brookfield, though, they're Byzantine, with their different publicly traded entities. But,
and if you look at the legacy of Brookfield, they've been around for many decades. So over time, you sort of evolve this complexity, whereas some of the other private equity shops in the US, they might be a little bit newer or not investing internationally as much. So they'll catch up over time. I think everyone's sort of trending towards that.
And remember, they used to be Brascan or Edper, and they were famous for their complexity even back then. NextEra, the big electricity company, was your next idea. This one not doing much over the period.
But flat.
Yeah, that's not bad.
And so again, in this market, if we can be flat year to date, we're happy with that. This is why we can't only focus on the tech names or the go-go names in the portfolio. We want to have some safety, like a NextEra. So they're a utility through and through. The cash cow in this business is Florida Power and Light. So they're sort of the Ontario Hydro of Florida. So they're powering a number of Floridians. There's demand for people moving to Florida because of the lower tax rates. So they're seeing an increase in subscribership. There's more people there. They also have a renewable business that's primarily wind and solar, but they're looking at adding nuclear into the mix going forward. And again, we're hearing a little bit of rumblings about data center demand, and maybe that will come off a little bit. But at the end of the day, AI is probably something that's not going to go away. And there will need to be more capacity built from a power perspective to power all of these data centers that are going to continue to pop up.
And then finally, Alimentación. This one has flagged a bit lately. Do some investors have, it's down over the period.
It is down.
Do some investors have doubts about that massive 7-Eleven deal if it comes off?
Yeah, so I think this concept of going out and it's not betting the company, but taking a big swing is causing some concern. There's been some pushback from the Japanese folks that run 7 & I, which is the parent company of 7-Eleven that they've been trying to buy. It's just, this is a company that it's Canadian in nature, out of Laval, Quebec, trades on TSX, but it's really global. And so having access to a company like this in your portfolio, we talked at the top of the show about consumer discretionary and consumer staples. This is absolutely a consumer staple. The average ticket here is somewhere around $8. So it's very easy for people to go to the convenience store. Maybe they're pumping gas, maybe they're buying food, maybe it's a drink, whatever it is. But this is something that's in people's lives, they've sort of mapped their path each day in partly going to the convenience store. So it's a name to hold. Interestingly, I've seen some analysis, and it seems like if they do get the 7-Eleven deal to close, and it's not a given that it's going to or not, right now it's very much up in the air, there'll be some U.S. assets that they'll have to sell because they already have a big presence in the U.S. But from a physical retailer perspective, number 1 will be Amazon, number 2 will be Costco, and then number 3 will be Couche-Tard in terms of sales. So a sleepy little Canadian company that no one's really ever paying too much attention to will be number 3 in terms of physical brick and mortar sales around the world.
Around the world or in America?
In North America.
Okay,
yeah.
That's incredible.
Yeah.
How big they'd be.
Yes.
Yeah, but the deal could cost tens of billions.
Yeah, so then you have to think about the leverage that they take on, and then what happens at that point to the underlying business. But again, it's a solid business. It's something that we think most Canadians should have in their portfolio.
We're going to be back with Brett Girard, Chief Financial Officer and Portfolio Manager at Liberty International Investment Management. Global stocks are on the agenda today. Cam is in Kitchener, Ontario. Go ahead, Cam, please.
Thank you for taking my call today. The stock I'm calling about is WSP Global, and it's a stock that seems to get sort of whipsawed back and forth a little bit with the price of it. And I thought as a global engineering company, it was something that might be a little bit more stable. Or is it just the fact that if the company or if the countries go into recession, that it might be a lot of pullback? I didn't think that it would be affected as much by the tariffs, and I guess I'd just like your thoughts going forward. Thank you.
Thanks very much.
So this is the new Genivar, I guess. Genivar is a name that everyone used to know and like. Yeah. They've sort of changed their name. A lot of S&C has changed their name as well. But this is a high quality Canadian company, again exporting services around the world. So they are not as affected by the tariffs directly, but part of the reason why we've seen the decline is that they're consulting for clients who will be building things, and for instance, the steel costs will be going up. So it's likely that the projects that they're putting in place will be more expensive, so that might compress their margins a little bit. But over time, if there's going to be infrastructure spend around the world, then a name like this will benefit front and center. We look at the 5-year chart, and the company's done exceptionally well. I think there definitely is volatility. Like we see prices moving up and down, up and down. It is a bit smaller of a company, so on a day-to-day basis, sure, there's volatility. But when you zoom out and look at a 5-year like this, it has been fairly strongly directionally up and to the right, which is what we look for in a name.
Would you be a holder of this one?
So we don't own WSP. We own Stantec, which is a close competitor. There are some differences within the business model. Stantec's a bit more on the environmental side. They have a bit more of a water presence and more exposure into the U.S. But either of these names would be helpful to have into a Canadian portfolio.
Let's head to Elliott Lake, Ontario, erstwhile uranium country. Jim, go ahead, please.
Hi, good afternoon, gentlemen. I'd just like your thoughts on CNQ. I know it tends to be a bit of a favorite for a lot of the portfolio managers that are on.
Yeah.
The energy sector has certainly been down, as we know, and as has this stock. It does pay a healthy dividend of over 6%. Is this something you like? And if you do, is this an entry point? I'm not sure if they're how much they're affected by tariffs here, but would you go into it now?
Thank you.
So we've been accused of being anti-oil, myself and my partner David at Liberty, and it's because we don't own oil stocks. Part of the challenge with CNQ and with the oil complex broadly is the regulatory regime in Canada for the last 10 years has not really given a lot of clarity as to what remediation is going to look like, what exploration can look like. Just the whole industry, I think, has been on pins and needles for the last 10 years trying to figure out what they can do, what they can't do, and what the costs will be. We have an election here on the 28th of April, and it seems like all parties are talking about the fact that we have to start to use our natural advantage, which is our resources, and potentially refine some of those here and then get those out to the coast or even down to the US at some point and start to benefit from that. So again, I'm saying this a number of times today, but we don't have enough clarity to see what the future is going to look like to buy a name like this. The dividend is great, but the dividend's high because they haven't been able to grow. They've been able to extract cash flow and pay that back to the shareholders, which is kind of you sit and you wait, but you're dying a slow death at that point. So I think for this company to do well going forward and to be the best that it can be, we have to see a clear regulatory regime. And again, hopefully that happens in the back half of this year. Right.
It looks to me the stock is at its lowest today since at least 2000. Oh, no, it got lower briefly in 2023.
Yeah, it would have had, yeah.
Certainly suffering, though, lately.
Yeah, and part of that is, if you see what's happening in the U.S. and the Treasury Secretary, Scott Bessent, has come out and said, we want more oil to be pumped. Right? The idea in the U.S. is part of the way that they're going to combat inflation from these tariffs is we'll just have an abundance of oil and energy supply, and then that will impact inflation in a negative way. There'll be lower gas prices that'll help the consumer. So that's going to impact the price of oil broadly and in particular with Canadian natural resources.
So that's not great for
not great.
margins.
No, it's not. But I mean, again, if you're going to buy an oil and gas company in Canada, this is the one to buy. They're the biggest, they're the best. But just for us, we need clarity to see what the future is going to look like.
Right. Just give me a sec. I'm just looking here. The 5-year return from CNQ.
Yes.
Well, not too shabby, actually. 400%, including all the dividends and stuff. That's over. But that's from the lows of the pandemic.
I was going to say, if you look, that was when oil went negative that day in March of 2020. So that's, if you're looking at a 5-year chart, that's going to be, if you look back to a 6 or a 7-year chart, might be a little bit more challenged.
Or even a 4-year chart.
Yes.
And I know you can juggle these things,
sure.
but you're closer to 133% return.
Yes.
So not as,
good high quality company, something that people could absolutely own, but just we have to get clarity on that regulatory regime.
Let's go to Jim in Kitchener, Ontario. Fire ahead, Jim, please.
Can we get your thoughts on Uber? Thank you.
Thanks.
Sure. So Uber, interesting name. They continue to get closer and closer to profitability. Some quarters we've been profitable, some quarters we've fallen behind. Stock prices sort of moved up and down as a result of that. I think for Uber, there's some end goal that would be similar to a Tesla, similar to a Waymo, where they need to get to self-driving cars. That's ultimately the future that they need to get to. And if they can be the first or the best to get there, then that's kind of what you're betting on with this company. But your guess is as good as mine if that's going to happen, when that's going to happen. So this would be a speculative name. You might have a small position in the portfolio, but I wouldn't be going in big right now.
I had to get an early train today and I took an Uber.
Right.
I'm glad I didn't cycle with that black ice. Anyway, we're going to be back with Brett Girard. He's taking your questions on global stocks. Let's head to Belleville, Ontario. Kevin, go ahead, please.
Hi. Thank you for taking my call.
Thanks.
My question's on the TD Bank. It's been moving up slowly, although a bit of a setback the last few days. The problems in the U.S. Have pretty much resolved with its penalty it paid and stuff. I'm wondering if you would be a buyer at this level. I think it's around $80 and change. It pays a pretty healthy dividend. Do you see upside for the TD Bank in the next year or so? Thank you very much.
Thanks.
So let's just think about what bank in Canada does. There's going to be some sort of sales and trading, so they're probably taking advantage of the market volatility right now. There's an investment banking division, which is taking companies public and raising money for those companies. Probably not too busy right now. And then the largest component, which would be the most concerning for me, is the loan book. So if you're one of the big six banks, you're lending money to people to buy houses, you're lending money to businesses to build out plant, property, and equipment, and whatever it may be. If you look at the retail consumers, so the people that are buying houses right now, we talked about how oil 5 years ago was basically negative. 5 years ago was COVID. And so if everyone can think back to what things were like 5 years ago, we were at the depths of COVID and interest rates were basically rock bottom. And that's when real estate was really taking off because everyone felt, oh, I need a second property or a third property. I'll go out, I'll borrow at 1.5% and everything will be great. And those bedroom communities went from maybe Burlington and Oshawa to Guelph or Collingwood and really far outside. And I'm talking about Toronto, but the same phenomenon happened in Vancouver, happened in Calgary, where some of those far-reaching properties exploded in value because people thought, I never have to go back to the office. We're now seeing refinancing 5 years later, and interest rates aren't at 1, they're at 3 or 4 or 5. And there's going to be a lot of challenges when you layer in the fact that these tariffs are going to hit in some way, shape, or form on top of house prices potentially coming down. So if you are investing in one of the banks, TD's very, very geared to retail investors and to sort of retail mortgage holders. You just have to be very careful. Layer on top of that the fact that they just got through this U.S. scrutiny, but they're basically restricted from growing the business in the U.S. over the next 4 to 5 years. So we used to own this name. We had it in our portfolio for a number of years, but when we look at the future, it doesn't look nearly as bright as the past does. So it's something that we've exited out of. We're no longer in TD, now we're in RBC, because they have a lot better of a balance sheet and they have a better outlook, in particular with U.S. growth, that TD just can't give to us.
Okay, so TD, a work in progress, and you're not keen on it right now. Okay.
No.
Peter in Toronto, go ahead, please.
Good afternoon, gentlemen. My inquiry is on Freeport-McMoRan. In terms of a trade in the next maybe quarter or two, what's your opinion? Of course, copper prices have to be taken into consideration. Thank you.
Yeah, so Dr. Copper, as they say, is sort of the metal that provides the most insight into the global economy. If we're talking tariffs around the world, that's not helpful for the global economy. So we've seen this name just basically fall off a cliff in the last little bit. And really, since Inauguration Day, things have kind of come down, and then with Liberation Day, it's really dropped. So sometimes there are names like FCX that you can not hold, but you can just watch, and it can be a tell for other parts of the portfolio. So this is just a good economic indicator for people to keep an eye on, but not something that I would want to hold for any period of time, just because there's so much uncertainty. To the question from the caller, is this a trade? It might be. We're not traders by any means. We're long-term investors, but you can see the volatility there. And if you have some insights as to how the tariffs might play out one way or another, then this could be something that you could hold for the short term and benefit from.
I'm just looking at copper in London because the New York market's been distorted by tariffs and all that. The price has plunged from about 10,000 to about 8,700 in a pretty short period.
So you're off 20%. That all flows through to the bottom line of these companies, and oftentimes there are hedges in place. So it's not like they're going to be selling at spot price tomorrow. But over time, if we do enter into a regime where there are a lot more tariffs, costs are a lot higher around the world for goods being imported and exported, then that will impact the demand on copper, which will eventually flow through to the price.
Amy is in Toronto. Go ahead, please.
Oh, hi, Brett. My question is on Alphabet. Just the way the stock market has been dropping, I just wonder if there's a risk of getting into it. On the hand, I was also comparing Palo Alto. I would like your opinion, if possible, on both stocks. I'll hand up and listen.
She's trying to sneak in another one there.
Right.
Do you want to take on both?
Yeah,
or
we can talk maybe Alphabet, and then we can talk cybersecurity, because that would be a Palo Alto play. So from a Google perspective, the big risk, and we hear this all the time, it's trading at 16 times earnings. You have a company like Google, which is one of the tech darlings, one of the Mag 7 that's had a phenomenal run over the last number of years. It's only trading at 16 times earnings. Why is that? It takes no longer than looking at the financial statements and seeing that the bulk of their revenue is coming from search. Now, if you've used any of these AI engines, ChatGPT, Perplexity, or anything like that, you can immediately get an answer with a full explanation, free of all ads. So there's a very realistic world where we move to a place where the ChatGPT or whatever it is, that AI-powered LLM, is going to give us our answers, and we're not going to Google, and we're not seeing the ads on a longer-term basis. And that would be detrimental to this business model, because although they have these other bets and lots of sort of skunkwork projects that they're working on, the biggest and the most important component of the Google complex is search.
That's interesting. Yeah. We want to get to your top picks, so we got to take a break. Brett's top picks coming up after this. First idea, Great-West Life, classic defensive stock?
Very defensive, yeah. Canadian name with operations in Canada, US, and into Europe. If you think about the products they're selling, it's insurance, life insurance, it's annuities, it's a lot of employer-sponsored pension plans. So they're long-term assets that you can't really touch. Less susceptible to the market volatility, not someone logging into their direct investing account and seeing prices up, prices down. So that's a really nice thing to have in the portfolio right now. If you look over the last 3 years, the name's done exceptionally well. Dividends been growing at about 8% per year, and the yield's just under 5% right now. So having something like that in the portfolio, it gives you the safety, gives you the income. You don't have to only have that, but this as a sort of a defensive name that you can have besides something more aggressive is really a good way to think about managing the risk in the portfolio.
Right, and it's one of those Demarais companies, and they tend to pay big dividends, or rich, pretty healthy
Lots
dividends.
of cash flow. The payout ratio is still reasonable. It's sort of less than 40%. So it's not like one of these telcos where they're taking all the profits and paying it out, which means that the dividend will be safe over time and still lots of room for it to grow.
Your next idea, Verisk Analytics, what do they do?
Yeah, so Verisk is a really interesting company. A bunch of the American insurance companies, the larger insurers, spun off Verisk, and it's sort of a database provider, but it does a lot more than that. It gives risk assessment, and what it does is it takes experience from insurance companies, it takes that information, slices and dices it, turns it into a very usable, digestible package, and then sends it back out. So it takes data in, cleans the data, and sends the data back out. And if you look at going forward with the amount of natural disasters that we're having and the things that are happening with climate change in the world, there's going to be more and more need to price insurance properly and to have more data to do so. So Verisk is a company that's heavy into AI, it's using big data, and it's really, from a consumer perspective, there's companies buying it, there's governments buying it, and as we move into this more efficient world, where you hear about DOGE in the US and governments in particular trying to find more efficiencies, a name like Verisk will give them a lot of insights by taking their data, turning it around, and then providing it back to them in an efficient way.
Right. My life insurance broker claims he can look at a person come into his office and tell whether they're going to get coverage or not, just from their demeanor.
Yeah, from the demeanor. Yeah. I don't know if they'll be doing that, but maybe there's some AI trends that are underneath that that the Verisk folks could help out with.
Look at somebody's face.
Right.
Yeah, no, we're not touching them. CN Rail is your last idea.
Yeah, so CN it's been a struggle. We hold this name, we've held it for a number of years, and the dividends continue to grow, so we continue to like it. If we look forward, and sometimes I think investors get caught in what's happening today and what's the headline today or tomorrow or the next day. But if we look forward 18 months and we see a world where we can get to a steady state with tariffs, maybe they're in place, but maybe there's a steady state, and we have more trade outside of Canada and the US, we're sending more things to the coast, there's going to be more demand for rails. If we see the political parties in power putting in place something that allows us to take more resources out of the ground, we have to efficiently get those resources from our country to other countries. And rail is about 3 times more efficient than truck, because you can put a lot of heavy materials on over long distances. Yeah. So looking into the future, there's a very bright spot to see CN Rail. We're seeing it trade at about 17 times next 12 months earnings, which is really cheap. Like we were there back in 2019. So the name is out of favor now, and this is an opportunity for investors, maybe add a little bit now and add a little bit in the future, but to continue to have a high quality name like this in the portfolio.
But wouldn't you be worried about existing cross-border traffic to America coming under pressure?
There might be a bit of a decline there, but if you look at the business and you look at the intermodal that they provide, I think if we're not trading with the U.S., we're going to end up trading with the coasts, and we're going to have something by rail go there. This is a country rich in resources, and we have to be able to get them out to get the value in.
Brett, thanks very much indeed.
Thank you.
Before we go, let's have a quick look at the North American markets, because we have come off the highs of the day last time I checked, and you can see the TSX actually slightly down. Maybe we could pop up an intraday chart for the TSX and the S&P 500. I'm just trying to work out what's dragging down the TSX right now. So it's very narrowly down, but let's have a look at the S&P as well, because it has come off the highs of the session. In Toronto, Shopify is now down. It's now down about or latest I looked, it was down about 0.33%. Enbridge down slightly as well, and Suncor slipping as well, down about 3%. And BCE, the parent company of this network, hitting a new multi-year low, down just over 4%. Thanks very much indeed for watching Market Call. Gordon Reed's up tomorrow.